Welcome to Barchart's weekly webinars designed to help you, the investor and trader, better understand a variety of trading concepts, along with the pages and tools that Barchart provides to support you in making a more informed investment decision. Today's subject, how to use ETFs to profit from price appreciation in future markets. So for many investors, the futures markets are too complex, volatile, and just not for them. But there are many investment instruments that allow a trader to profit from a recognition of price action without that high leverage risk futures markets provide. And namely, these are exchange traded funds, or more commonly referred to as ETFs. Hi, my name is John Rowland, and in today's session, we're going to look at a number of different types of ETFs and whose price movement is highly correlated to that of futures markets. And as well, I want to hopefully help you determine which type of ETF is best suited for your particular investment needs and your risk tolerance. With me today is my partner and our moderator, Jean Baker. Hello, Jean.
Hi, John. How are you?
How are you? I'm fine, thank you.
Good.
So
Doing
let
well
me
over
ask
here
you
too.
this, Jean.
Okay.
From our discussions when we have these meetings, we talk about futures. Futures is probably something that you're not that keen about or interested in, but ETFs are. Would you agree with me on that?
Oh, yeah. Futures to me are a little bit scary. You have contracts that are expiring and all that margin and maintenance. Yeah, I kind of look toward ETFs or stocks instead.
Something that's a little bit more digestible and certainly risk tolerance manageable. So that makes a lot of sense, and a lot of our subscribers would fall into that category. So you're not alone, Gene, I would say
Oh,
on
good.
that. So just, do a little compliance here and disclaimer. Remember that the decision to buy, sell, or hold any trade, any security, commodity, or investment involves risk, and that is best made on the advice of a qualified financial professional. And just remember that today's session, as we go through different ETFs, this is not an endorsement of purchase or trading any particular ETF, and just make sure that when you consider any type of investment, that trading is suitable for you in light of your financial condition and what risk tolerance or how you can bear financial risk. So just keep that in mind as we walk through today's session. Okay. So where do we start, right? And there's a couple places we can start. So what I'm going to do first is I'm going to go to futures. And on the futures page, we have a page that's called long-term trends. And what this page does is it kind of shows us, wake up, there it is. It's going to show us some of the longer-term trends. Now, why we're going to start here is because this page will help us not only see these longer trending futures markets, but will help us also to look at how our ETFs are relating to, or ultimately when we choose an ETF, are they correlating or reflecting these futures market price trends, okay? So the first one that pops out right here at the top is lumber. And if I click on lumber, it takes me to the lumber futures page. Again, I know that we're not going to be actually trading the futures contract, but I just want to show you a couple things here. Our contract specs, contract size, ticks, exchange point values, margin and maintenance, things that Gene was talking about, and expirations. That's why a lot of folks are not interested in futures markets, because of all of these different variables or risk variables. But before we go a little bit deeper in here, I do want to point out over here to the right is we see Barchart's trading guide. Now, We're going to look at this a little bit later in our session. But this is a system that we have on our page that will, trading system that will show you a recommendation or telling you, identifying a potential trend for this particular futures market. And you can see right now, it's giving us a sell signal. So that would be, part of my process of when I start looking for a trading opportunity. Do I want to look for a sell signal or do I want to look for a buy signal? We'll go a little deeper into that a little bit later. All right, relatable instruments, right? And again, here you're going to see a lot of different other variety of futures contracts, but down at the bottom of this list, we do see the Beacon Global Timber Index, and this would be a index that would be compared to the prices of timber products or the related industries. Okay, then if we scroll down a little bit deeper, we do see lumber related ETFs. And this is really where we're going to start our discovery process of what lumber ETFs we might invest in. And so here we see wood is one of those ETFs. The other one here is cut, right? So I'm going to go to that, and I pulled up another page so we can kind of flip back and forth here. And so now what I've done is I've gone to the wood page, the price overview page. And here we're going to do, again, some more discovery about the particular ETF there was. And again, we have a little chart that will show us the price action. And then here's some technical opinions based on Barchart. So you can see that right now, for the ETF, the technical indicators are still showing a strong buy, right? Down here under the fund basics, we see the family of funds that this ETF is representative of, BlackRock shares, how many assets under management, how many shares, the beta, the price earnings, if there's a dividend. And the one thing that I want you to keep in mind as you are going through different ETFs is the management fees. So, the industry average is somewhere between 0.5% and 1%. If you are looking at an ETF who is charging you greater than 1%, 1.5%, 2%, or 3%, or maybe even some that could be as high as 4 or 5%. You better make sure that ETF is performing, or there's a reason why they're charging you a larger management fee. Okay, so if I scroll down a little bit deeper into this web page, I can see that we have the summary, and that's part of our discovery of our ETFs. And what is the fund's summary? So here we see these iShare Timber Fund is an index composite of global equities. And now what this says to us is this ETF is what we would call an industry-related ETF. It's based on the equities that revolve around the timber industry and the prices of those equities. If I scroll down a little bit farther, here's our top 10 holdings, and you can see that in this particular ETF, they do hold shares of different global equities throughout the world. And if I wanted to go a little bit deeper into that, I could click onto that and actually see the makeup of our ETF. So just, kind of give you some background information here. If you see one of these equities in blue, that means that is a publicly traded company. If you see it in black, that means they own shares in a private company, right? So they have equity shares. Some of the equities that we're looking at here trade on the US markets, some trade in other areas. So like TO, I believe that is the Toronto market. And if I click on that particular equity, it would tell me that this is on the Toronto Exchange. Down here you can see TX, right? So just be aware of that as well if you're looking at different equities, okay? All right, let's go back to wood. All right, so what other things can we do, or what other features that are on this page that'll help us in our selection process? Well, after we look at the fund's summary, we discovered that in this case, this is an equity-based or index based on equities. But we can also do some comparison. And here we have our related instruments, and we have wood, and then we have the futures contract, the LSH21, that stands for lumber March contracts. And then we have the Beacon Global Timber Index, again, that index that is a composite of different equities on the S&P market. And here we can do some price comparison. We can do some technical analysis comparison, performance over a certain period of time. Notice that when we get down to the key statistics, these are really for equities. So notice that under the futures one and under the index one, we have no information because there's not a market cap, or there's not outstanding shares, there's not annual sales, or things to that nature, right? So don't worry about that if you don't see that. The other thing we can do is we can add other symbols. Now, one of the other timber ETFs was cut, and I'll put that one in there too. And we can also do a comparison based on a chart. So if I click on the chart comparison, right, what this will do now is it's going to look at the price of timber, or the timber futures contract. It's going to look at price of my fund, and notice that we do see here on the upper left-hand corner, we do see it is in a percentage. So I'm going to go back to where it says compare, and I can compare by price. But if I'm looking at a multiple of assets and they have a variety of prices, maybe one's like $15 and one's $1,500, then my chart's going to get a little distorted. So if I just do it based on a percentage change scale, I'm still going to get that comparison that I need to see to tell me if my ETF is tracking my futures contract. You just be aware that the values might be a little bit different, okay, in terms of percentages, all right? Now, if we look at this comparison here, we do see that the blue here represents the futures contract, and the pink line is the cut ETF, and the gray line represents wood, the other one. So you can see that, and this industry-related ETFs, they do appreciate, they are tracking, they are tracking that as lumber prices were going up. These are the folks that are actually making lumber. Their ETF, that those stocks were doing well, but it's not shadowing the futures contract, right? It's not actually following it in lockstep. So that's usually what we'll see in industry-related ETFs. Now, if we talk about other industries that could be related to the lumber market, one of the ones that that I am aware of is the S&P sector of home builders, XHB. And again, I'll apply that. And you can see here, again, they're not falling in lockstep, home builders. So, we can look at, in the case of lumber, as a way of looking at the health of the lumber industry, but also the health of home builders. Now, home builders do have a love-hate relationship with lumber prices. They like it when lumber prices are cheap, but for us, we really kind of want to see lumber prices rising, because that's telling us that there's demand for lumber prices, and demand for lumber prices means that home builders are probably making homes, and that would be good for them. And many times you'll see home builders ETFs start to appreciate as lumber prices go up. But if lumber prices get too high, then of course that adds to the cost to building a home, and that could be a negative for home builders. And so you can see that, where we have lumber prices have gone up relatively very high in a very short period of time, the home builder ETFs kind of stalled out for a little bit here. Now, there's another component to price for commodities, and for instance, in lumber, is not only is the demand, but is the supply. So when we do this analysis of price on a commodity basis, we want to make sure we do a little bit of homework on that as well. And so just give you a little background here in the lumber market. Yeah, we do see a lot of new homes being built and a lot of demand for lumber, but on the supply side, there is probably also an effect of why lumber prices have gotten very expensive. And so a couple of things is all commodities are related to the dollar index, and a stronger dollar lowers the value of commodity prices. A weak dollar increases the price of commodities. And so in recent months, the dollar has fallen in value, and that has allowed commodity prices to appreciate. In lumber in particular, we get a lot of our lumber from Canada. And remember, when we looked at those equities that this fund held, a few of those equities were in the Toronto stock market. So they're actually trading on the Canadian lumber companies. And also remember, we had COVID, and a lot of the mills have lowered their capacity because of, social distancing, practicing and trying to protect their workers from COVID. And also one more piece would be, if you also remember, in the last few years, we had some major forest fires out west, and a lot of the U.S. production areas suffered inventory loss due to these forest fires. So just for lumber in particular here, it is a combination both of greater demand and lesser supply. Okay. All right. So let's go back to our futures page and long-term trends. And the next one we can see is soybeans, all right? And I'll click on soybeans. And again, here's a nice chart for the last 6 months. Here's one for a year. And you can see that, soybeans have really taken off in the last few months. Again, relatable instruments, our Barchart trading guide signal, buy signal, all right? Matter of fact, our maximum signal. And again, those contract specs that are related to that futures contract. Scroll down here, we do see now, so we do have soybean related ETFs. Now, when we look at this box here, normally what we'll see is the first one will be the futures contract, and the rest will be ETFs. Now, again, when we do this comparison analysis, remember when we looked at the timber, we saw timber was up like 70%, but the ETFs, those industry-related ones, were only up about 25 or 30%. But here we see that our ETFs are close, very close in terms of percentage gains as that of our futures contract. So this could be telling us a story of, are these ETFs more in line with the futures contract? So I've picked the Soybean futures ETF and gone to that page. And here we see the chart, and you can see that this chart looks very similar to our soybean chart, right? Well, a big acceleration of price in the last few months. Again, some basic fund information. What is the family of funds? how many assets under management, and management fees. And so you can see this one does charge 2.5% management fee. That is going to take away from some of your results, that percentage gain because of those management fees. All right. Some of our relatable instruments, again, I can see those, and we'll come back to this and do a price comparison in a second. But I want to again look and see what the fund summary is. What is the purpose of this fund? So what we can see here is this fund provides investors with an unleveraged direct exposure to the soybeans market without the need for a futures account. In other words, what they're saying here is you get the same price appreciation of the soybeans futures market, but you're not trading futures. You're not going to get that leverage of the soybeans futures contracts, but you're going to get that price appreciation. And what we can see down here is that the fund's purpose is to help you reduce the effects of rolling contracts, futures contracts that expire, and this concept of contango and backwardation. And these are two fancy words based upon how much the difference in price is from one futures contract month to another. I'm not going to go into a lot of depth on this. If you're interested about contango and backwardation, inside of our tools and our webinar, free webinars library, there are two webinars on the futures trading guide. One is from, let me check my notes here, from July 29th, and the other one is from September 2nd, that goes into a little bit more detail about this contango and backwardation. Just to make it simple for you, contango means that the front month or spot contract is cheaper than the forward or future contracts, and backwardation means that the front month or spot month contract is more expensive than the back month contracts, and that will have an effect on the ETF. We kind of want to look for ETFs whose futures markets are in backwardations and not in contango. And we talk about that in those webinars, okay? So an unleveraged direct exposure to futures markets. Okay, so we'll come back to our related instruments and we'll do that symbol comparison. And here's our ETF. Here is our futures contract, and here's that relatable index. If I go to my chart comparison, again, remember I'm going to do this in a percentage and not in a dollar price action. You see now that our ETF is tracking more in line. It's shadowing the futures contract. Now, some of you might notice right away that, hey, the ETF is only up 47%, and futures prices, we can see the blue over there in the left-hand corner, the ZSH21 is up 59%. Again, there's a difference between the different futures contracts the fund will be using. This particular fund uses forward contracts and not the spot contract. So we're only looking at the price performance of the March contract. So it's maybe outperformed the fund because maybe it was cheaper or it has increased in value a lot faster. This fund in particular is not trading the front contract, the March contract. It's trading forward ones, July, November, into the future. Those are some of the futures contracts that are in the soybeans market. So that's why you might see that difference. Don't forget we have a 2% management fee as well. Notice that the index does hold step for step with the futures prices. But again, this is, if I was going to look for an ETF that is going to be reflective of this commodity market, this one would solve my risk needs and the purpose of why I want to be in these particular futures markets, okay? So I'm going to go back to the price overview of this particular ETF. And I want to also show you that there are other ways we can look for ETFs that are related to our futures contracts, not just the ones that are in these two boxes here. And down here he says ETF sectors, and I'm going to just pick on the grains one. And here we do see there are some competitors to this particular ETF, and some of them are grain indexes, some of them are for other grains, some of them are baskets of agriculture products. Now, this is the first time we've seen the term ETN. And these are a little bit different than ETFs. And ETN stands for an exchange traded note. This is an unsecured debt, and the holder earns a profit or return on asset based on the performance of the index over a certain period of time, or maturity, for instance. Some ETNs provide principal protection, but most commodity ETFs do not do this, right? But there are some ETNs that do that, okay? So these are based on securities or debts that are based on an index or some other derivative products. So just be aware that these are a little bit different than what we can consider our classic equity ETFs. Now, I see a couple questions popping up here. So before I move away here, let me see if I can answer some of these questions. So Brian's asking about shorting ETFs. Brian, stay with me. We'll look at maybe an opportunity to talk about that as we move forward. Sid says, is it favorable from a margin perspective to sell soybeans options on futures contracts? So Sid, let's concentrate on ETFs. And yeah, there's a lot of benefits for trading options or futures. Again, we're talking about leverage. And when we talk about ETFs, we're getting low leverage compared to the futures or the particular ETFs itself, okay? David Simpson asks, what is the industry standard for management fees? David, that normally in ETFs, especially equity ETFs, is somewhere between 0.5% and 1%. That's really where you want to be. If my ETF has a large management fee, in the case of this one, there's a reason why. Why is it? Because they have to manage a lot more risk because they're trading those actual futures contracts that are related to the soybeans prices, okay? All right. All right, so we can look at these different sectors of ETFs to find either competitors or other ETFs that we might see that could be performing better or giving us a greater price shadowing or lockstep to our particular futures market. So another place we can go to look for ETFs is under our ETFs page. We have popular ETFs. And, there's a lot of different types of ETFs, global, U.S. industries, special indices, fixed income. But down here, we do see commodity producers and commodities in particular. And again, we can look inside of these ETFs, and a lot of these would be what we would call those industry-related ETFs. Notice that under the commodity producers, we do have an ETF called MOO, which is based on the agriculture markets. All right, and I think it's gonna pick that up. My screen is refreshing as it does. So again, if I was saying I saw a major trend in all of the commodity grains, for instance, that might be an ETF that I'd be interested in. But down here under the commodities one, right, notice that we do have commodity indexes, and we do have some other ones that are based on certain commodities. So let's go to this one, gold, the GLD. This is the spider. And what this one is again, this is an ETF that is going to be based on the price of gold. We got to just see what that relationship is. Again, some basic fun information. If I wanted to learn more about State Street Global Asset Advisors, this would take me right to their website. Again, our Barchart technical opinion for the ETF is a weak sale. What are some GLD related ETFs, other ETFs that are related to the GLD? We do see several different ETFs. Now, here's where we're going to see a couple different types of ETFs that take on different leverage, right? So most ETFs are what we call a one leveraged markets, but here you do see there is the ultra GLD, which is 3 times. So what that's telling us is that that one has a leverage of 3 times that is greater than the GLD. So when price of gold goes up, in theory, for every percent the GLD goes up, then this one could go up as 3 times as much as the GLD. It has a 3 times leverage. If we see a negative times, this is telling us that the leverage is an inverse or a sell, right? Most ETFs are longs, where we're buying, right? Here is one that sells. So Brian, there's your answer. There are ETFs that allow us to take short positions because in futures markets, we do have that opportunity. Now, just be careful because as we gain greater leverage, we're taking on a greater risk. And boy, you can see it really here. Here we see the GLD, which is a one leveraged ETF. For the 3-month period, it's down 2%. Where the 2 times leverage, right, it's down 6%. It's actually down greater than 2%. So greater leverage, greater risk. Okay, so just be aware of that. Okay. So again, where can I look for other relatable ETFs? So again, precious metals. I mean, the spider gold, the GLD, is probably the granddaddy of all ETFs, one of the first ETFs. And here are some of the GLD's competitors. So when we talk about physicals, especially metals, physical commodities, there are 2 different types of ETFs I want you to be aware of. So we have what is called a trust. Here's a silvers trust, and down here we have the gold trust. And trusts actually own physical assets. They actually own gold. They put it in a vault and they own it, but they don't manage it. They don't speculate. They're not trading the futures contracts, right? Again, I could look at my description. It says that the performance of this ETF is based on the given time, any given time of the price of the gold owned by the trust. So if you see the word trust in your ETF, that tells you it's a physical and they actually own that particular physical commodity in that case, right? If you see one that says index, that again, that is a basket or a composite of price of an industry or futures contracts or other derivatives. So many times in commodities, you'll have a choice between indexes and trusts. Okay. All right. So let's go back to the price over page. And I'm down in here on my relatable instruments. And we're going to do that comparison. And here's our GLD. There's our futures contract, our February futures contract. Here's a dollar-based gold index, and then here's the Goldman Sachs gold index itself. And here we can see that they all kind of correlate very, very nicely, lockstep in terms of the price of the futures market and the price of the ETF itself. Again, if I was going to look at a comparison, let me take away a couple of these here, and let's just look at let's say the gold miners, the GDX, I believe that's the symbol for gold miners. Notice that it doesn't follow in lockstep, but it's close, it's pretty close, right? And sometimes you can see that equities outperform the actual futures market. Sometimes futures market outperforms the equities. Since the crash of March, gold miner stocks have done well, and that's been on the back of a strengthening gold market. But the gold market has since moved sideways or fallen, and yeah, look how much the gold miner stocks have fallen, a lot more than gold itself. So relatable industry ETFs do tend to sometimes outperform and underperform compared to the futures markets, okay? So again, let me reiterate that indexes track the price of the underlying commodity, and trusts actually hold the physical market, okay, the physical ETF. So let's go back to our ETF page under our popular ETFs, where we found that before. And I wanted to kind of show you some of the other ETFs that are based on some commodities. Notice that there's, we can trade very unique commodities, uranium or water or wind, right, or lithium. So again, these are futures markets that I wouldn't even trade, but here's an opportunity to invest in some of more of these esoteric or very unique or exotic futures markets, okay? All right, so another way we can look for ETFs and those futures markets is I can go in and look at ETFs by asset class, not just popular. And here I can filter based on equities, commodities, currencies, fixed income, right? So let's pick commodities. And we have broader commodity indexes, metals. We just look at gold. We have our agricultures. We just did a couple ags. Well, let's pick energies, another popular sector that a lot of investors like to trade in, and it's given us a lot of different energy ETFs. And then we can really break this down. We can even go down even farther. Let's look at crude oil. And now what it's done is it's given me it's broken it down by commodity, energies, and now I'm just focusing on crude oil. Also up here, here's that opportunity to look for those different types of leveraged ETFs, 2 times, 3 times long leverage, see where it says long here, or minus, which would be a short leverage. So if we look under assets under management, we can see that the largest of all the crude oil ETFs is the USO, the United States Oil Fund, and that has almost $4 billion under assets. Okay, so let's go to that one. And we can look at our chart and see what this has been doing. And notice that the price of this ETF, it has been rising, but it's not really rising as fast as those of us who are astute traders know that crude oil prices have almost doubled in the last 6 months. And this one, the ETF has not. So again, we'd have to look and see, is the ETF doing what we want it to do? There's our related ETFs. There's our related instruments. Here's the fund itself, and then there's that crude oil futures contract. So we can do that price comparison. Oops. Again, remember, we're going to do it in a percentage, and you can see that on a 6-month chart, it's pretty much lockstep. So the USO is doing a good job of tracking crude oil prices. Again, the performance is a little bit less than the actual spot market, and that could be because of that contango or backwardation, that the price of oil futures contracts might be less than or greater than the spot market. But if we go to, let's say, a 2-year comparison, and this is what I was really kind of pointing out to you guys, is that, what has happened in the USO in the last year or so is that it hasn't really been performing as well as the underlying futures market. And there could be a reason why. Now, USO has restructured the way that the fund's purpose is, and you can see that in recent months it is getting a little bit more reflective of the futures contract. So again, this is where we need to do that homework. What is the ETF doing, right? And it says that here it's going to track securities designed to track the daily price movement of West Texas Intermediate, the crude oil contract, based on futures contracts, right? But then we look at the top holdings, right? Again, is it an equities, or is it an index, or is it a physical? And in this case, we'll see that it's trading futures contracts. It's holding the WTI March, April, May, June, July, August, and the December futures contracts. So it's holding a number of futures contracts. But here's where we need to do that deep investigation. And here we can see that under management is $4 billion in assets. And yes, it is trading futures contracts to try to keep lockstep with futures. But we look down here, we can see that the USO has almost $2 billion in reserve cash. So one of the reasons why the USO has underperformed in the past is that in order for it to hold all these futures contracts, it has to hold all this cash to pay for, those margins for all those futures contracts. And so why it kind of lags futures price movement is because it's really, half of it is part of the futures market, but the other half of it is actually an interest-bearing ETF. Now they're getting their act together and they're putting more asset in, but because of the way futures markets are designed, and because this one is such a huge ETF, it will always have to hold a certain percentage in cash, and that's why the USO will always lag in the price relationship to crude oil. So maybe if you are going to be a crude oil, trade crude oil or crude oil related ETFs, you might look for leverage, a little bit greater leverage, or look for those industry related ETFs, maybe oil producers or pipelines or infrastructure or service industries, as those crude oil prices start to improve. All right, so let me see if I stop here and look at some questions. Gene, do you have any questions that are popping up that are kind of common?
Let's see. I've been passing questions on to you, so I think you've been answering some of the common ones.
Okay. Let me get over here to look at my questions because I really want to go and finish off really nice. Oh, hey, Jim, how's it going? I'm a retired capital preservation is high priority. If I buy an ETF and I want downside protection, should I buy a put or use stop loss? Yeah, Jim, I would encourage any trader as part of their trade plan. And if you want, that we do have a webinar where we talk about trade plans, where I believe that all trades start with a stop. So great question and comment. Yeah, for sure. I definitely would have a stop loss for any trade that I put in. Okay. Sid asks, is it favorable from a margin perspective to sell soybeans? Oh, we talked about that one, Sid. Yep. Okay. All right. Okay, so let's go back to the futures page, and we're at the long-term trends. And I know what a lot of you are thinking right now. Yeah, John, this is really easy for you to pick ETFs that have performed well when you look at a futures contract that is up 25 or 30 or 40 or even 80%, right? What you're probably saying to me is, how can I find that new opportunity? How can I find that new trend before it goes up 25, 50, 75%? Okay, and we do have tools and access that allows you to do this. And let me show you how we can combine what we've just learned today about ETFs and learning how to find those trading opportunities based on new trends. So I've gone back into futures, and I'm down here where it says Futures Trading Guide. I'm under the Trading Guide. And this is a system that Barchart has created based on two moving averages that makes like a MACD, where we talk about crossovers. Again, I would refer to you to those two webinars that we've just recently had, one in July and one in September, that talks about how this trading guide is put together and how you can use it. But let's go back to soybeans. And here we see that the March soybean contract, right, the trading guide, gave us a buy signal. Now, not only did it give us a buy signal, but currently it's the strength of that trend is the maximum. And that buy signal was created on December 12th of 2020. Now, if I bought one soybeans futures contract today, that futures contract in price value in profits for me would be up $9,000. And so this is the reason why people trade futures contracts, because of leverage, because of these greater profit potentials. The greater the risk, the greater the reward, obviously. Okay. But we're going to make a comparison here in terms of equities in a second. So let's go to view details. And again, here's our chart. It's going to show us the price action, right? And here was the buy signal that came on the December 18th, right? December 18th. And, you know, how much profit is it up? And we would have been in this trade for 26 days. Okay. Right. So the trade signal came from our futures trading guide. I don't want to trade futures. I feel like they're too risky or there's too much leverage, and I'm not ready to take on that risk. But before I move away from this page, down here it says margin maintenance. And if I was going to maintain a position in a futures contract of soybeans, it would cost me $2,750. So let's use that as an apples to apple comparison. That's how much my investment would have been in this futures contract. So $2,750. Now remember what that ETF that we traded was? Well, it was Soy B. And we can see our chart looks very similar to our soybean chart, okay? And we'll go to soybean. Now I'm going to take off those comparatives that I had before. Oh, it already did it for me. Good, excellent. And this is the price action of soybean. And let me scroll this down just a little bit for you. Okay. And here was the day, December 18th, when we got the buy signal in the soybean futures contract. So on that day, if I wanted to buy the ETF that related to that futures contract, I could do that. And let's just use a comparison, make it very easy here. So on the 18th, the closing price was $18.49. And you can see that on the top left-hand corner there, you can see where it says 1840. I'll move it up, 1849. So we said that we're going to invest $2,700, $2,750. That would have been the margin I would have had to put up for buy one futures contract, but I'm not trading futures. I'm going to trade equities. I'm going to put $2,700 towards this ETF, right? And my closing price was $18.49. And that would allow me to buy 148.72 blah, blah, blah shares. So let's just round it up, make it a lot easier for ourselves. Let's just pretend that I was able to buy, because if I buy 1.3 more shares, it's only going to cost me another, $40 or so. I'm going to buy 150 shares, okay? So where has price gone? Well, we've gone from 1849, and currently right now the ETF is trading at 2093. So that's a price appreciation of what? $2.45, 46 cents, $2, and let's make it nice and easy, $2.45. Okay, so 150 shares that appreciated by $2.45 would return a profit of $367.50. I know, when we talk about one futures contract that's up $9,000, it doesn't seem like that's a lot of profit. But remember, we're only on one leverage here, where the futures contract for soybeans right now is about a 30-time leverage. So, I mean, we're getting a lot more reward for the more risk that we're taking on. But remember, our initial investment was $2,700, so we'll take our profit, $367.50, and we'll divide it by our initial investment, right? And we'll times that by 100, and the net result is that in the 26 days that I would have been able to be long this ETF, I would have a return of 13% in this equity. Now, as far as equities are concerned, I think we can all agree that if I can make 13% in 25 days or inside of a month, that's a pretty good return on my investments. Trading equities, right? So here's where we can use futures contracts, use futures markets to find us some trading ideas in our ETFs. So I do see that we're coming towards the end of our time together. I'm going to kind of look at some of the last questions before we pop out of here, but I do want to give you a couple final thoughts and some takeaways. So a well-diversified portfolio contains a mix of all assets, and ETFs are definitely part of that mix, right? And ETFs have exposures to many different types of assets or equities, and that we can use some ETFs that are exposed to commodity markets, and what I've given you an example so today, that can improve and help us outperform and give us a greater diversification. You just need to be aware how that ETF is priced, right? Remember how much exposure or leverage that ETF has. Is it an industry-related ETF? In other words, is it an equity base? Is it an indexed in ETF? Or is it a trust, right? Does it actually own the physical assets? And again, what is that leverage that we're going to take on? So I do see that I think I answered most of the questions. Are there any other questions that have popped up, Gene? I don't see any that I don't think I haven't answered.
I believe you've gotten through most of the questions here. So one last thing I'm going to ask you to talk about is, let's see. Oh, hold on. I've got somebody asking me to make sure that you answer this one. What is the reason to choose an ETF over a normal old-fashioned fund? Do you have an answer to that?
I think they're talking about a mutual fund. Yeah, I think what the discussion that we've had here is finding ETFs that are related to futures markets, commodity futures markets in particular is what we've done. So is there a benefit or a reason why we would choose one over a mutual fund? Well, there could be management fees, or it's the risk exposure or the what I want to try to achieve, right? My price objective in terms of, I'm looking at gold, or I'm looking at oil, or I'm looking at grains. I want them to be my ETF to be in lockstep. That's why we looked at those indexes and physical ones. Where a mutual fund is probably not trading futures contracts or trading an index. It's probably trading a basket of equities that are related to some of these commodity markets. Now, there are ETFs that are related that don't trade in lockstep. But what we want as a trader is we want that greater diversification. So I hope that answers that question. I think it does. I'm not sure, but
John, why don't you talk to everybody about next week's session, because I really do think there's going to be a great interest in having you dig into a favorite page on Barchart.com. So tell us about next week.
Yeah, so next week we're going to go into the trader's cheat sheet and look at the value of this as a tool. We're going to make the distinction that the trader's cheat sheet is really for our day traders that are as our subscribers, but even longer term traders can find some value in the trader's cheat sheet. And we're going to talk about things about like trend and momentum, and using the cheat sheet to help us zone in on not only looking for greater potential or risk management in terms of entries, but also because a day trader exits all their positions by the end of the day, also will give us some more realistic targets, or where we should probably take money off the table instead of being a greedy piggy, because as a day trader we run out of time before the end of the day. So I think I'm looking forward to this one. I know Gene's looking forward to this one, and I will hope that all you will take time to sign up and come and hang out with us next week for sure. Anything else, Gene?
Well, just a reminder to everybody that you will get an email a little bit later on today with a link to the recording. John is on our webinar archive page already, the webinar recordings, and you can always go back and listen to other webinars that we've run from that archive. That's about it.
Okay, well, listen, everyone, best of health, stay safe, and the good of all trading.
Thank you, everybody, and hope to see you next week. Thank you for using Barchart.com.